Welcome to The Explainer. Today we're going to tackle something you hear about all the time on the news, something that has a huge impact on your financial life: monetary policy. We're going to pull back the curtain on central banks and see how they act as the economy's thermostat, trying to keep things from getting too hot or too cold. So here's our game plan. First, we'll dive into what a central bank actually does. Then we'll take a look inside their toolkit to see what levers they can pull. After that, we'll explore what it looks like when policy really works. And finally, we'll get real about the limits of their power and why they can't solve everything on their own. All right, let's start with the basics. What exactly is a central bank's main gig? Well, it's not like the bank on your corner. Think of it more like the conductor of a massive and, let's be honest, sometimes chaotic economic orchestra. Its job is to make sure all the different pieces are playing together in harmony. A central bank wears a lot of hats. I mean, look at this list. It's the only institution that can print money, it's the government's banker, and the bank for all the other banks. But the roles that are absolutely crucial, especially when things get dicey, are being that lender of last resort and, of course, using monetary policy to keep the whole economy on track. Okay, let's talk about the actual money we use every day. It's called fiat money. That's just a fancy way of saying it's not backed by a physical thing like gold. You can't just walk into a bank and trade your cash for a gold bar anymore. Its value comes purely from our collective trust and belief that it's worth something. That's a pretty big responsibility to manage, right? So that begs the question, what happens when that trust, that confidence, just evaporates? What happens when people start to panic? This is where the central bank has to step in and play one of its most critical roles, the lender of last resort. And this isn't just a textbook theory, this is a real and frankly terrifying example. Remember the run on the British bank Northern Rock in 2007? When word got out that the bank needed an emergency loan, people totally freaked out. They lined up for blocks, desperate to pull their money out. The panic only stopped when the government, with the full backing of the central bank, stepped in and guaranteed everyone's savings. It's a stark reminder of why you need that ultimate backstop to prevent one bank's failure from causing a total meltdown of the entire system. Okay, so now we get why central banks are so important. But how do they actually do all this stuff? What are the actual levers they can pull to manage the economy? Let's get into their toolkit. Central banks basically have three main tools they work with. First, they can buy and sell government bonds to inject or remove cash from the banking system. That's open market operations. They can also change the reserve requirement, which is just telling banks how much cash they have to keep on hand. But the one you hear about all the time, the real headliner, is the policy rate. The policy rate is the big one. In the US, you'll hear it called the Fed funds rate. In the UK, it's the bank rate. Whatever the name, it's the interest rate the central bank charges other banks. You can think of it like the wholesale cost of money. And when that one rate changes, it sends a ripple effect through every other interest rate out there, from your mortgage to your credit card. So, how does that ripple effect actually play out? Well, the first channel is super direct. Market rates. If it suddenly costs your bank more to borrow money, guess what? They're going to turn around and charge you more to borrow, plain and simple. Second, it hits the value of our investments. When interest rates go up, it can make future company profits seem less valuable in today's money. That can push down stock and bond prices. And when people see their investments shrink, they tend to feel less wealthy and might cut back on their spending. The third channel is all about psychology. It's about our expectations. When a central bank hikes rates, it's sending a powerful signal to everyone. Hey, we're trying to slow things down a bit to fight inflation. When people hear that, businesses might delay a big expansion project, and families might decide it's a better time to save than to spend. It helps the central bank do its job. And finally, there's the exchange rate. Higher interest rates in a country are kind of like a magnet for foreign money. Investors from all over the world want in on those better returns. All that demand for the currency makes it stronger. And a stronger currency makes imported goods cheaper for us, but it makes our exports more expensive for everyone else. Okay, so it's super important to remember that central bankers aren't just pulling these levers at random. They have a very specific goal in mind, a target they're trying to hit. And for most modern central banks, that number one goal is keeping prices stable, which really means controlling inflation. Now, for this whole inflation targeting thing to actually work, a central bank needs three key things. It's got to be independent, so it can make tough decisions without politicians meddling for short-term gain. It needs credibility, so when it says it's aiming for 2% inflation, people actually believe them. And it needs transparency, clear communication to build that all-important credibility.
And independence isn't just a simple yes or no thing. It's more of a spectrum. For instance, the Bank of England has what's called operational independence. The government sets the 2% inflation target, but the bank gets to decide how to get there. The European Central Bank has even more freedom, target independence, where it sets its own goal and decides how to hit it.
And you can see a really clear pattern when you look at this table. Almost every major developed economy is shooting for inflation around 2%. So why not zero? Well, zero is dangerously close to deflation, where prices are actually falling, and that can be absolutely catastrophic for an economy. And why not say 5%? Well, that would kind of defeat the whole purpose of price stability. So 2% is like the Goldilocks number, not too hot, not too cold.
But here's the thing. Central banking is powerful, for sure, but it's not a silver bullet. It has its limits. It can't just magically fix every single economic problem that comes along.
And this brings us to the biggest, most challenging question that has faced economists for the past 20 years. The central bank's main move in a downturn is to cut interest rates. But what on earth do you do when interest rates are already pretty much at zero? You can't cut them any lower. This nightmare scenario has a name. It's called a liquidity trap. It's when people are so nervous about the future that they just hoard cash, no matter how low interest rates go. Businesses won't invest, consumers won't spend, the economic engine just completely stalls out, and traditional monetary policy is basically useless. So, to try and escape this trap, central banks had to get creative and unconventional. You've probably heard of the most famous of these tools, quantitative easing, or QE. This is where the central bank essentially creates new money out of thin air to buy up massive amounts of government bonds. The whole idea is to flood the financial system with cash to push down long-term borrowing costs and hopefully jolt the economy back to life. And this really highlights a critical point. The central bank can't do this alone. It's in charge of monetary policy, but the government controls fiscal policy. That's all the decisions about taxes and spending. In a crisis, these two have to work together. You can't have one hitting the brakes while the other is flooring the gas pedal. You know, way back in 2002, years before he had to steer the ship through the 2008 financial crisis, then Fed Governor Ben Bernanke made this famous promise. He was signaling a modern central bank's greatest fear, deflation. He was basically putting the world on notice that the Fed would do literally whatever it took to stop prices from going into a downward spiral. And that leaves us with one final big question for today. After everything we've been through, global financial crises, a pandemic, the rise of unconventional policies, is the toolkit that was designed for the 20th century still the right one for the challenges we face today? That is the massive question that central bankers all over the world are grappling with right now.